Gold didn't just rise, it snapped a long-held assumption in half. In the final days of January 2026, the metal pushed beyond $5,200 an ounce, with prints around $5,211 on January 28th, and it kept running into the first days of February. That's not a normal risk-off drift, that's a repricing event. And it didn't unfold over months, not weeks. In 48 hours, the market behaved like it was, being forced to recognize something it had been refusing to price. They said this could never happen, not because gold can't move, but because the system that trades gold is built on the idea that it doesn't need to move like that. Gold is supposed to be the slow heartbeat under the financial machine, stable, a barometer, not a lightning strike. But when the barometer turns into thunder, it's telling you the storm is already overhead. Here's the uncomfortable part. When these moves appear, institutions are rarely surprised. They are usually positioned. The surprise is reserved for everyone who watches the headline price and assumes the headline is the story. The story is what forced the move and why it arrived with that kind of speed. Because speed is information. Speed is the message hidden in plain sight. And the message is this: the gold market is not one market. It's two markets layered on top of each other. A paper market that can create exposure at the push of a button, and a physical market that has to be mined, refined, shipped, insured, vaulted, and audited. Most days, those two markets behave like they're the same thing. Then a stress test hits and the seam shows. What I'm about to lay out changes the way you read every gold chart you've ever seen. Not because it turns anyone into a prophet, but because it turns the price into a clue instead of a conclusion. Patterns are what institutions trade. Price is what the public notices after the pattern has already done its work. Welcome to Channel Name, where we decode what matters before it becomes a headline. If you've been here before, you already know the rule. We follow the data, not the noise. If you're new, think of subscribing the way you'd listen to a wise elder at the edge of the room, the one who doesn't speak often. But when they do, they connect dots. Nobody else is willing to connect. And drop a comment with where you're watching from, because this story isn't local, it's global. Late January 2026 gave the gold market a jolt that looked like a simple breakout. But the timeline matters. A move into the $5,300 is not just a new number, it's a new regime. The price didn't climb a staircase. In the same window, the paper layer kept doing what it always does. It traded scale. On February 2nd, 2026, COMEX gold futures volume was reported around 434,930 contracts, with open interest near 451,79 contracts. One standard gold futures contract represents 100 troy ounces. So that day's trading volume alone is roughly 43,493,000 ounces of exposure. That's about 1,353 metric tons if you convert ounces into tons. The number matters because it shows the asymmetry. The market can trade a year's worth of mine output in a single session without moving a single bar. That isn't a moral judgment. Futures are built for liquidity and hedging, but the same design creates a vulnerability. A market that can manufacture paper exposure can also manufacture paper stress. If collateral tightens, if volatility rises, if margins change, the paper layer can force repositioning fast. When that fast repositioning collides with a physical layer that cannot respond at the same speed, you get a distortion that looks like random volatility to casual observers. It isn't random. Now zoom out, because the deception isn't a villain story. For decades, the public story of gold has been tidy. Inflation goes up, gold goes up, rates go up, gold goes down, fear rises, gold rises. It's comforting because it feels linear. But linear stories break under pressure because markets don't move on one variable. They move on constraints. They move on who must buy, who must sell, and who cannot get out of the way in time. When constraints tighten, the hierarchy becomes visible. The paper layer can dampen moves for a while. It can smooth and net and roll. A spread widens. A vault that looked full starts behaving tight. An official buyer keeps absorbing even when the headline narrative says there's no reason to. Those are the signals, and they tend to appear before the public story catches up. This is where it gets interesting. In 2024, central banks added roughly 1,045 tons of gold. 3 tons, roughly a 20% drop. And yet 863 tons is still historically elevated. A buyer that is considered slow and conservative is absorbing metal in quantities measured in the high hundreds of tons per year. That is policy expressed through metal. In 2025, Poland led reported official purchases at about 102 tons. One country adding more than 100 tons in a year. That's not a trade, that's a statement. And at the same time, analysts and market participants repeatedly point to the possibility that some buying is not fully visible through official reporting. You don't have to assume anything dramatic to understand the implication. Official demand is large, and the incentives to diversify reserves have not gone away. One more clue sits inside the quarterly rhythm. In the fourth quarter of 2025, reported central bank net purchases were about 230 tons, roughly 6% higher than the prior quarter. At the same time, investment demand surged, with total investment demand for 2025 cited around 2,175 tons. That combination is unusual. Official buying stays large, while private money piles in after prices have already made repeated records. When both engines run together, it tends to compress available float because some metal is moved from tradable inventory into long-term hands. The chart shows price, but the flow shows intent. And intent drives repricing. Now pair that with the infrastructure of the physical market, 261 trillion, representing roughly 728,512 bars. That sounds like abundance. But inventory is not the same as availability. Some of those bars are allocated to specific owners, some are pledged, some are part of financing chains. Some are simply not for sale at any price that a paper market can dictate in a moment of stress. A vault total is a snapshot, not a guarantee of smooth delivery. So you have this picture. Central banks keep absorbing. Vaults report massive totals, but totals don't tell you how much is freely mobilizable. And the futures market trades exposure at a scale that makes the physical numbers look small. Those three facts can coexist peacefully right up until they can't. To understand why the move into early 2026 matters, you need historical context. Gold does not announce the problem, it reflects it. And it reflects it with a rhythm that repeats through different decades. In January 1980, gold hit a famous benchmark, $850 per ounce at the London afternoon fix on January 21st. That price didn't appear because people woke up and discovered shiny objects. It appeared as confidence cracked under a mix of inflation, geopolitical strain, and currency doubt. The result was not just a top, it was a regime shift. Policy tightened aggressively afterward. Volatility became the teacher. The market learned that when gold moves violently, it is often because something else has already broken. 15 per ounce on September 6th. It was a period when the financial system was still carrying the aftershocks of 2008, with sovereign debt stress and persistent policy experimentation. The result was another lesson. Gold can rise even when the consensus says the crisis has passed, because the plumbing remembers longer than the headlines do. Then look at March 2020, because this is the clearest example of dislocation between paper and physical. That is not a normal arbitrage gap. That is the sound of logistics, refinery constraints, and settlement pathways breaking down under stress. It showed in numbers that one gold price is a convenient fiction in calm periods. Now bring it back to 2026. A move to the 5,300s and then to prints above $5,500 in late January, according to some market reports, is not merely a bigger version of the past. It's the past signature in a higher dollar world. The rhyme is the important part. Fast repricing, heavy institutional accumulation, and rising tension between paper claims and physical preference. So who are the players, and what are they doing? Start with the institutions that can buy without asking anyone's permission. Central banks and official reserves managers. Their mandate is stability over decades, not quarterly performance. When they buy gold by the hundreds of tons, they are signaling a desire to own an asset without counterparty risk. They are also signaling an interest in diversification away from a world where reserve assets are increasingly entangled with politics, sanctions risk, and debt trajectories. You can disagree about motivations. The scale still speaks. Then there are the exchanges and clearinghouses that manage the rules of the paper layer. The CME and its clearing system, for example, sit at the center of the futures ecosystem. Futures markets are brilliant for hedging. They allow miners, refiners, jewelers, and financial institutions to lock in prices. But futures also concentrate leverage. A contract controls a large notional value with a margin deposit that is a fraction of that value. In calm markets, that is efficiency. In stressed markets, it is sensitivity. When margins rise, leverage compresses. When leverage compresses quickly, forced selling appears. Forced selling can push price in the short term in ways that look wrong relative to the macro story, because it isn't about valuation, it's about survival. Traders close positions because they must meet collateral calls, not because they suddenly formed a new philosophical opinion about gold. Now add the bullion banks and dealers who operate between paper and physical. They make markets. They lease metal. They finance inventory. They provide liquidity to both sides. Their business depends on a basic assumption that paper claims can be satisfied without strain because most participants will not demand metal. When that assumption weakens, the first reaction is not a press release. It is a quiet change in terms. Spreads widen, financing tightens. Preference shifts from unallocated accounts to allocated bars, from convenience to certainty. There are also the large funds and asset managers who treat gold as a portfolio component. They can move the headline price through inflows and outflows, but they also respond to signals. When official demand stays strong and the market shows signs of plumbing stress, funds don't need to believe in doomsday. They only need to recognize that repricing often follows sustained constraint. The coordination is rarely explicit. It doesn't need to be. When different players respond to the same shared constraint, their actions align in time. Timing creates the appearance of coordination because the pressure is shared. Now let's talk about the dislocation, because this is the heart of the signal hidden in plain sight. The paper market tells a story of infinite liquidity. You can buy exposure in seconds. You can sell it in seconds. You can hedge, roll, and cash settle. The physical market tells a story of finite reality. You can't print a bar. You can't conjure a refinery output overnight. You can't swap a spreadsheet entry for a pallet of bars if the buyer insists on delivery. Most days, the paper layer sets the benchmark. That's not controversial. But the moment physical preference rises, the benchmark can lag the truth. You begin to see the symptoms: unusual premiums, delays, shifting flows, and stress in the links that connect one market to another. A 5. That number was the market admitting, briefly and loudly, that the layers had separated. Think of it like a theater with 2 ticket systems. One system issues digital tickets that can be traded instantly. The other system controls the actual seats. As long as everyone is fine holding digital tickets, the theater seems unlimited. The moment people start asking, "Where is my seat?" the theater reveals how many seats actually exist. The digital tickets don't evaporate, but their relationship to the seats becomes the story. In gold, that relationship is the spread between paper convenience and physical certainty. Here is what the evidence looks like when you stop staring at price and start watching structure. On one side, you have immense paper turnover. Hundreds of thousands of contracts can trade in a day. Open interest can sit in the hundreds of thousands. The paper market can represent, on paper, thousands of tons of exposure. That scale is possible because of netting and the fact that most participants do not stand for delivery. The system is built on the assumption that liquidity will resolve claims. On the other side, you have official buyers removing metal from the floating supply. You have vault inventories that look large in aggregate, but may be constrained in what portion is freely deliverable. You have an increasingly global demand profile where different regions treat gold differently. In some places, it is a short-term trade. In others, it is a long-term anchor and a cultural store of value. And you have growing investment flows when fear of currency debasement and debt expansion rises, even when other markets look calm. When those two sides collide, dislocations appear. Sometimes they appear as obvious spreads, like in March 2020. Other times, they appear as behavior, a stronger preference for allocated holdings, changes in lease dynamics, tighter availability of specific bar types, and rising urgency to secure metal rather than a promise. And the reason the gap cannot persist is simple. Paper can promise, but physical must deliver. If a critical mass of participants insists on physical settlement, the paper layer either adapts or compresses. Adaptation can look like higher premiums, altered delivery incentives, or settlement pathways that steer participants toward cash rather than metal. Compression can look like a violent repricing as the market tries to ration limited physical availability through price. This is not conspiracy, it's mechanics. So how does the deception happen, and why does it keep working? It works because most people confuse the map with the territory. The futures price is a map. The metal is the territory. The map can be redrawn rapidly, traded rapidly, and used to navigate. But if the territory shifts, if underlying availability and preference change, the map can mislead. The mechanism is straightforward. In calm periods, leverage expands. Paper trading grows because it is efficient. Hedgers hedge. Speculators speculate. Dealers warehouse risk. As leverage expands, the market becomes more sensitive to collateral. Then a shock arrives. Tighter funding, higher volatility, or a shift in confidence that makes certainty more valuable than yield. When that shock hits, the system attempts to reduce leverage. It does this through margining, risk limits, and the self-protection behavior of market makers. Margin increases are not punishment. They are a risk response. But they change behavior instantly because they change the cost of holding exposure. In 2011, during the silver spike, the exchange raised margins 5 times over just 8 or 9 trading days. The result was not philosophical. The result was forced deleveraging. A paper market can reverse fast when leverage is squeezed. Gold has its own version of this dynamic. Even without a single dramatic headline margin hike, the ecosystem can tighten through financing. Terms, inventory costs, and dealer risk limits. When that tightening happens, participants who were comfortable holding paper exposure discover the carrying cost has changed. Positions shrink, volatility rises, and then, after the forced repositioning, the physical layer reasserts itself because the long-term buyers did not buy for a weekly chart pattern. Let me make the complexity simple. Imagine a supermarket that sells bread. People trade those receipts. Most never pick up bread, they just trade receipts. The store likes it because it keeps traffic flowing. Then one day, customers start showing up and saying, "No receipt trade today." If too many do that at once, the store has two options: raise the price of bread sharply to slow demand, or change the rules so fewer people can demand bread at the counter. The receipts still exist. The problem is the link between receipt and bread. That is the gold market under stress. So what does this mean going forward? Historically, when gold reprices rapidly while official accumulation remains heavy, the system tends to resolve in one of three ways. The conservative scenario is digestion. Price cools, volatility fades. The market builds a new base at higher levels while the paper layer adjusts to a new reality. In that world, the signal isn't a straight line up. The moderate scenario is recurring dislocation. Price swings widen, spreads and settlement preferences become more visible. The market becomes sensitive to plumbing indicators that used to feel irrelevant, like delivery, notices, vault flows, and the tone of official sector commentary. In this scenario, gold stops being one number and starts being a system you have to read. The aggressive scenario is a regime shift. Either the paper price rises enough to ration physical demand, or the rules evolve to reduce the pressure on deliverable supply. Historically, these shifts arrive after denial, and they often show up as sudden revaluations, structural changes in settlement incentives, or a persistent premium that refuses to close. Not because anyone wants drama, but because constraints eventually force resolution. Notice what isn't here. There's no guaranteed outcome. Markets are probabilistic, but the pattern tells you what to watch. Watch whether central bank purchases remain large, even if they fluctuate year to year, because official demand is slow-moving but powerful. Watch the behavior of the futures market beyond the chart: volume surges, open interest changes, and the market's response to volatility. Watch for signals that physical preference is rising, persistent dislocations, unusual premiums, and stress in the mechanisms that connect London, New York, and the wider bullion network. And watch the narrative's tone. When the mainstream story becomes gold is doing this for reasons we can't quite explain, that often means the drivers are structural, not emotional. Now we come to the divide, and this is where most people miss what's in plain sight. The divide is not between smart and dumb. It's between those who pay attention to structure and those who only react to outcomes. Those who understand that price is the shadow of constraints see the signal earlier. Those who don't see it wait for the headline. And by the time the headline arrives, the repricing has already happened. Information gap becomes wealth gap because institutions move first. They move first because they have better data, better access, and better incentives. They are paid to manage risk before it becomes obvious. When you see gold move to levels once considered impossible and you see the move happen fast, the question isn't whether the world is ending. The question is what the system is quietly admitting through price. Gold is not predicting doom. It is reflecting a shift in preference, away from promises and toward certainty, away from convenience and toward possession. That is the signal hidden in plain sight. This is channel name, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. And remember, the real question isn't whether the market resolves this tension. The market always resolves tension. The question is whether the mechanism was visible to you before the resolution forced everyone else to notice.